And welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by Alan Higgins. Now, each week on the podcast, we look at the three things investors need to know. Now, that could be for the week ahead, but we also focus on longer term trends. And Alan does the research, or reads the research, I should say, so that you don't have to. But before we get to that, Alan, as always, we've got a little bit of a catch up to do. First off, last week you talked about some research that Merrill Lynch had done looking at contrarian signals, and you promised us you were going to come back with some hard data. So what's the data then? How successful are these contrarian signals at predicting a kind of rise in markets?
Okay, so there are other banks that do this, but we're just picking on the Merrill Lynch one. Hi, Sarah, by the way, I should say. And yes, they've got a so-called bull-bear indicator, and basically they go bullish when everyone else seems to be bearish. What does that mean? It means people selling. So they measure outflows and they measure sentiment and they measure the amount of cash that they can see in portfolios, amongst other indicators. So since 2002, there's been 20 signals when it's been very low, i.e. people have been very bearish, including one right now. Okay, out of these 21, including one today. Out of the 20 that we've seen in the past, basic pretty good news. Again, as a reminder, the median 3-month return is about 8%. So that's the median out of 20. But there are 4 big declines in there, more than 5%. So 4 times out of 20, it really didn't work at all. There was also 4 very big increases, more than 10%. And the rest of, up a bit, generally up, the odd small decline. But I think the big picture is 16 out of 20 ain't bad, to paraphrase Meatloaf. You know that song?
Yeah, I do know that
2
song.
out of 3 ain't bad.
Yeah,
we need to get that. We need to incorporate that at some stage.
We do. So more times than not, these contrarian signals actually prove to be a good thing. These very ultra bearish kind of mood in markets actually proves to be a good time to go into markets. That's essentially what we're saying then. Not all the time, but more often than not. Okay.
Nothing's guaranteed here. And, many teams, including our own investment team, take these kind of indicators into account. Can you use any one indicator on its own? Definitely not. It's dangerous. Yeah. But it just goes to show next time, obviously we've moved on a bit from the pessimism. We're a bit, this was obviously a signal 1 month ago when the world did look very pessimistic in terms of especially equities. But just a reminder, next time, we're all fretting about the world, remember, ideally look to do the opposite.
Yeah. Okay. And that's what contrarian signals are all about. Okay. Well, thank you very much for that. That's very interesting. Now, I know we were chatting this week, earlier in the week, because there's been a lot of press about, this has got absolutely nothing to do with finance, but it's got a lot to do with, well, you and me. Basically, according to Nicky Haslam, I think we're both quite common, aren't we? Because he's just released his latest, what he thinks is common list, of which I think they tick quite a few of your boxes, don't they, Alan?
Yeah, a lot. I mean, some are, I admit, being common. So Aperol Spritz or Aperol in general, fine. Yeah, kind of is common, but I like it. It's refreshing. But relevant to us, podcasts.
Yes, I know.
Are now common. But tell people, who is this strange guy? This strange fellow?
Nicky Haslam is he's an old Etonian. He's an interior designer. I probably used the wrong word because he probably doesn't like the term, but he's become more famous in recent years because he produces a list on a sort of fairly regular basis of what he thinks is common, and it's completely arbitrary, and everybody gets quite exercised about it, and there's really no point because it's all, I suspect, a little bit tongue-in-cheek. I mean, previous inclusions have been things like hedge funds, skiing in France, which I believe is another one of yours, and art as well. I mean, I'm not quite sure how you can say art is common, but this all harks back to good old Nancy Mitford in 1955 writing about you and non-you and how language kind of marked you out as being upper class or not upper class. But yeah, so Nicky Haslam, we're basically officially on Nicky Haslam's common list because we do a podcast.
I think where he's slightly onto something on podcasts is there's so many. And look, we're providing one, so thank you for listening to ours. But I do listen to others. And you may have noticed we have changed the format because I realized myself, I listen to podcasts late. And so there's no point. So there's about to be US inflation. And don't worry,
Yeah.
we'll cover it in a bigger picture scene next week.
Absolutely.
There's no coming in data because most people listen to podcasts late, walking or in their car, etc.
Mm.
And there's an awful lot of competition. I've probably got 3 or 4 I need to listen to.
Yeah, no, you're right. Actually, I've got some that I do listen to the minute they come out, and I dive on them like crazy. But I've got other ones that I do listen to regularly. But yeah, it might be a week later that I'm actually listening to them. That's a fair point. And then the only other thing, this relates back to a previous episode. We talked about Birkin bags and sort of Birkin as an investment. And for those that want to listen to that episode, it was from the 8th of August. So I was doing a little bit of research, I should say, on Sotheby's website, because they've just had a very big sale of luxury handbags, of which a number were Birkins. And it was interesting to sort of look at the prices. And certainly the most expensive one in the recent sale they had was a very smart red crocodile one that sold for around 53,000 Swiss francs, which I think is about 51,000 pounds roughly. But interestingly, and if we were talking about as an investment, actually the Birkin 25, just in a normal sort of finish, which is the rarer of the Birkins, which is the smallest of the Birkins, actually holds its value up fairly well. I think the retail price, and this is a tricky thing, is actually trying to identify what the retail price is, because you can't just go into an Hermes store and go, hello, I'd like to buy that Birkin up on the shelf, please. How much is it? Because it's not for sale, essentially. But a guide price of around about $10,000, which, if it's in really good condition, will resell for up to $21,000. So you're getting your money back. I mean, obviously you've got fees and things to be considered on that as a bid offer spread, as you would say. But essentially, that's not bad. But if you look at the top end, the most exclusive end, which is your Himalayan Birkin, so called because it's crocodile and it's dyed to sort of grade from dark grey to white to mimic snow-capped Himalayan peaks, apparently. If you get one of those with sort of gold hardware and diamond studded, the retail price is around about $250,000, but they would expect to reach at auction around 315,000. I'm talking dollars here.
Surely
it's not bad.
Would call that common, that specific.
Almost definitely that is common.
Yeah,
almost definitely that is
but the
common.
basic one I get, and so look what we said before. We were looking for assets that compete with equities in particular. We talked about Wimbledon debentures. By the way, Wimbledon is common, according to Nicky Haslam. And
as is Henley Regatta apparently as well.
Okay, there you go. And so there's no doubt. You mentioned bid offer spreads. I'm glad you did that. But luxury stocks have been great investments as well. So we stand by stocks. But look, we concede there are other investments, but it's quite a challenge to get a Birkin bag. You know what? I might go into a Hermes shop when I'm next in Bond Street, and I'm going to basically say, "Have you got any Birkin bags for sale today?" And I'll come back, and if they have, I better buy one, I suppose. But I doubt it. But let's just see if they laugh in my face. So
okay,
there's research for me to do next time I'm in Bond Street.
I was going to say that's your field research, to go to Bond Street and go into an Hermes store and see if they'll sell you a Birkin. Okay, I await with bated breath. All right then. The only other thing I wanted to mention is I did notice that Moody's have been a bit negative about US debt. Sort of thoughts on that. I mean, probably we'll reflect on that when we come to sort of talk about US inflation, but because we were talking last week, weren't we, about this sort of unsustainable debt levels that we're seeing across economies, and maybe that's reflected a little bit in Moody's sort of negative comments about US debt.
Yeah, I mean, the US is a standout right now with budget deficits, as you mentioned, depending on who you measure it, 6 to 8%, but in times of strong growth. And it's a bit of a worry, although I do remember a famous Ronald Reagan story back in the day when he was one of the first to go for, obviously, different politics, but one of the first to go for deficits. And true story, he was interviewed, by the press. And, let's dare to say, I mean, not necessarily the most financial person, but he had a great kind of put down in a way. So someone from the Wall Street Journal basically said, Mr. President, the deficit looks like it's out of control. It is 5% of GDP. Our debt to GDP is approaching 60% of the economy. it's whatever, approaching 1 trillion, whatever the number was. Sir, are you worried? And he said, son, don't you worry. The deficit's big enough to take care of itself. End. And you know what? The amazing thing was, he was right, because growth was so strong, the budget deficits went away. But anyway, that was a different era. Let's see if this Biden approach works. But we better crack on.
We'd better crack on. Yeah, we've got. And I feel like I ought to say, if anybody's listening to this and they think that Alan's not quite on top form, although I think he is on top form, we had a very long-standing, esteemed colleague of Coutts, who it was his leaving party last night.
Yeah,
Alex. And Alex is famed as a wine lover. So by all accounts, it was a very, very good evening, to which I wasn't invited, but I won't hold that against either of you.
If I slip up on my words, you'll know why. But let's crack on.
Let's crack on. So what are the 3 things we need to know this week, Alan?
So last week we had Howard talking about how he incorporates momentum into helping the team pick stocks. So another look at that, and a bit of a surprise. How's that performing year to date? And then, dare I say, my favorite factor, because these are called factors, quality. I'm going to talk a little bit about quality again. So factors, so that's the kind of meat and potatoes. And then kind of 6 months on from the Credit Suisse demise, a little over 6 months over the Credit Suisse demise. And Sarah, if you ever read or hear investors say, after this experience, I'm never going to do that again, don't believe it. And we've got an example to go through on that. And then finally, I can't believe we've covered Beyonce. I can't, and the impact on Swedish inflation. True story. Report by Danske Bank. You can Google it. Taylor Swift or Swiftonomics.
Swiftonomics.
How come we haven't covered it? And kind of linking into why does GDP, especially in the UK, get revised upwards? Well, Swiftonomics. But let's go for it.
Okay, well, I'm looking forward to that one. Let's kick off then with this. As I say, we had Howard Sparks on. I believe it was the 31st of October he was on. If you want to listen back to that episode, he was talking about US earnings, but we talked a little bit about his sort of approach, which is sort of very much momentum trading. And I guess it hasn't actually been a great year for momentum trading, has it? Well, not across the board.
To be fair to Howard, momentum isn't the only thing he does. But he incorporates it into his investment approach. But the way he incorporates it it works, and it helped to identify, for example, NVIDIA amongst other stocks. But the surprising thing is that when you try to formalize that, so MSCI has tried to formalize that, it's kind of hard to make it work. So, for example, you can buy an ETF, exchange traded fund, from many providers on momentum. One provided by MSCI. If I tell you, Sarah, the US stock market is up 17% as we speak, how do you think momentum would have done? With the likes of NVIDIA, Microsoft, etc.
It should have done even better than that, shouldn't it?
You would think so, wouldn't you? Wouldn't you? No, only up 2%.
Really?
Yeah. You know why? They've got whipsawed. That technical term. What does that mean? So the way MSCI do it, they change their baskets in May and November.
Okay.
So previous winners, including last year, dollar stocks, healthcare, utilities, they were held instead of the NVIDIAs, the Microsofts, held with bigger weights. To be fair, no one's choosing 10 stocks here. This is index construction. But if you like, it's late momentum. They bought into the NVIDIAs of this world too late, which is different from how Howard did it. And therefore, it really has lagged. To be fair, in the long run, it has been fine, but it is really remarkable how poor it's been as a pure factor. So, I mean, especially in the US, but to a certain extent over here, you can buy many, you can choose a factor and just invest in it. And that's momentum. And I just want to kind of talk about quality again, because ESG is in the press a lot. And you might think, hold on, Alan just said quality. Why is he bringing ESG? I'll explain.
Exactly. Well, and remind us what we mean by quality as well.
Exactly.
We're not talking Birkin bags here, are we?
Yeah, we're not talking LVMH or Hermes. What we're talking about is, for example, MSCI look at 3 factors, very sensible: return on equity, profitability, Okay, the amount of debt, low debt being good, kind of quality. And then the volatility of earnings, they actually look at 5 years. So how volatile are profits? Because a quality business is steady, if you like, a Nestle of this world, a Procter & Gamble of this world. Now, okay, those have been great investments. They're up 22% year to date.
Okay.
So quality investing is working really well. And in the long run, you know how hard it is. We've covered active investing versus passive investing, haven't we, Sarah?
We have, yeah.
Can't remember when. We'll definitely come back to it because it's an ongoing topic.
Yeah.
I mean, basic quality investing is one of the few factors that have kept up with the US equity market. Momentum hasn't, but quality has.
Okay.
So I think it's really interesting. Now, the link with ESG is this. There are hundreds and hundreds. I just asked ChatGPT, as an AI, to tell me exactly how many there were. Unfortunately, it couldn't tell me. So I had to resort to old-fashioned Google.
Okay.
But there's hundreds and hundreds of academic papers. Does ESG work? And nearly all of them say yes. But the one I like the most, which sounds like it's negative, but it's not. It's from EdHec, which is business school down in Nice. It's called Honey, I Shrank the ESG Alpha.
Okay.
Yeah. So
Explain.
I mean, it's a 1980s film. It's a play on a 1980s film.
I do remember that film.
Remember with Rick. Rick, God, you can tell this is not scripted. Rick Moranis, is it?
It is. I think it is Moranis. Yes.
He's also in Ghostbusters. Yeah. Anyway, we digress. Anyway, this research, which I think is exactly right, they show that good news, ESG investing works. Environmental, social, and government investing works. Why does it work? Well, because it's basically completely associated with or can be explained by quality investing. Because if you think about it, if you start to underweight, I'm not talking anything about the Coutts approach here, just talking generally. If you start to underweight the more volatile energy and commodity stocks, which have less of a weight in typical ESG indices, well, guess what? They're not considered quality companies. So I think it's good news. I stand by quality investing as a core investment style. So rather than seeing it as, negative, oh, there's no ESG alpha. Yeah, of course, there's no ESG alpha. It is all quality investing.
Okay. So essentially, and what we're saying then is sort of ESG funds typically by default, not perhaps by intention, end up sort of following a sort of quality strategy.
Quality and a certain amount of growth. If you think of it just intuitively, they're going to be underweight. If you think of the UK, BP, Shell, etc. And look, these have been phenomenal companies in the long run, but volatile, and overweight more stable companies. Now in the UK, they can be hard to find. Unilever comes to mind, but not always. But that's the intuition behind it.
Okay. And if we're talking about quality, we're talking about companies that offer good return on equity, have sensible levels of debt, and have sort of limited volatility of earnings, essentially.
Correct. There are many ways of doing this. This is the way MSCI do it. It's pretty sensible to me. There's other ways of looking at this as well, but that's a good start.
Okay. So what about the future then? What's the outlook then for this sort of trading and for other sort of factors that we haven't talked about?
Well, it's very easy talking about the past. If you ask me to talk about the future, we will be doing that, won't we? About the homage to Byron Ween when we talk about the surprises of next year. But look, I stand by quality investing, and it's not the best. It's not the best factor. These are called factors, investment factor every year, but it's so consistent.
Yeah.
And I think that's underrated, the consistency of quality investing. Look, there's other ways of investing growth, value. We've mentioned momentum, but I like the consistency of quality. So I would stand by that. Quality, in contrast to quality, value's having a terrible year, as you would expect, except in markets like Japan, actually. Interesting, in Japan, value's screaming up. Which is an interesting development. But yeah, stick with quality. So you asked for prediction, quality.
Okay, all right then. So that's sort of factor trading and that link between ESG and quality. next up, it's, as you say, it's roughly 6 months on from what I've seen it referred to as the shotgun wedding between UBS and Credit Suisse. And you mentioned at the top of the podcast that investors have got very short memories, haven't they? Tell me about that. What's been happening with UBS?
Yeah, we'll be brief on this one because we've got to leave a lot of time for Taylor Swift. So
Exactly.
what we're talking about here, call it bankruptcy, call it forced merger. What happened at the time? Okay. So basically, subordinated debt holders were wiped out. So-called CoCos, AT1s were wiped out controversially, about 17 billion of value in this shotgun merger. So just looking at the maths to where we are today, senior bondholders, so this is senior bondholders, absolutely fine. They're up 17%.
Wow.
There was some concern that could the Swiss do a Lehman here? And thankfully, they've learned from them lesson because Lehman defaulted on its senior debt. They didn't, but bonds were priced 80, 85 in some cases. Okay. There's been a nice 17% return on Credit Suisse senior debt. Shareholders, as it stands today, they've merged into UBS. If you're a Credit Suisse shareholder, you've merged into UBS, and UBS shares have gone up a bit, but you're still down 50%. So look, if you let's put it this way, you put €1 million into senior debt, you've now got 1.17. Put €1 million just before into equity, you've now got 500,000. You put €1 million into CoCos, you've got zero.
Yeah,
everything's gone. So at the time, many people said, we're never going to trust the Swiss. We're never going to buy CoCos again. Guess what? UBS issued a CoCo. It was somewhat in demand, wasn't it, Sarah? You had a look at the numbers.
It was. I looked at the numbers. I think so. They issued $3.5 billion, but there was a demand of something like $25 billion for that.
Exactly.
Which seems incredible. Billion. Very short memories people have got.
They do. It started with a 10% coupon. So they started saying, we're going to pay 10%. And that obviously got a lot of people excited, and they forgot about Credit Suisse. To be fair, those experts listening in, I know this structure was slightly different. This structure is meant to convert into equity as opposed to be completely written off. So it is slightly different. Anyway, in the end, the coupon, I think, was a little over 9. But, decent compensation for the risk of UBS going bust or having to merge with someone. You would think 9%, it sounds big, right? So fair enough. But short memories, Sarah.
Yeah, exactly. Yeah, never. This time is different, to quote that oft-used phrase when we're talking about markets and economics. Hopefully, this time is different. All right, then, let's move on to our big topic for this week, Swiftonomics. We've talked about the Beyonce blip, and for those of you that want to listen back to that episode, that was from the 20th of June, when we talked about how Beyonce had basically been responsible for, I think, was it Sweden's inflation?
Blamed, because that's where she started the concert. Yes. Exactly. It seems like yesterday.
But yeah, Swiftonomics, and also this ties in with this point that we've talked about before, the fact that sort of GDP numbers are often revised up, and why are they revised up? And maybe they're not taking into consideration some of the sort of secondary effects of some of these things that are sort of quite vibrant in the economy.
The service sector in general, yeah. I mean, before we go there, though, Taylor Swift, a fan? And what was your last rock concert you went to?
Do you know what? I don't own a Taylor Swift. I've never downloaded a Taylor Swift song, but I do think she's good. She's evidently good at what she does because she's very successful. I think she does good pop songs, as much as I know about.
And last concert for you, just to see where your taste is?
My last concert, I haven't been to a concert since before COVID. And it was Brian Ferry at the Royal Albert Hall, which was one of the best ones I've ever been to. It's a good one.
I went to one just a couple of weeks ago. Not as fast as that. A 1980s, 90s NAF. Some people think NAF. I think he's a genius. Rick Astley.
Rick. Oh, do you know what? Actually, I imagine he's probably it's a good event. Is it?
It's a great event. He's very funny. He's a superb drummer, by the way.
Oh, really?
Absolutely superb. He started as a superb drummer. He looks great. He's only a little bit younger than me, I think, or maybe even the same age. I don't know. He looks fantastic, and his voice is good. So no doubt I would be considered common, right, as a Rick Astley fan. Well, maybe not. Maybe that's
well,
contrarian.
you don't know. Probably the Royal Albert Hall is common, but maybe Rick Astley isn't.
Okay, there you go. So, Rick, look, Taylor Swift.
Yeah,
I'm at danger. For me, I'm at danger of sounding like one of those judges, who said, who's told about the Rolling Stones or the Beatles, but it kind of passed me by until I'd never really listened to any songs. And then there's a very good obscure, and I'll get the name for next time, Australian zombie music, and there's a song called "Shake It Off."
Yeah, which is a classic,
which is a hit from Taylor Swift.
It's a good one.
I'm really sounding like an old judge now.
Even anyway, I know that one.
Yeah, I have to admit, it caught my ear, so to speak, and impressive. But look, the business of Taylor Swift, phenomenal. And do you know what her father does?
Well, apparently he's in the sort of investment business, isn't he?
He's got the same job as us. He's a wealth manager at Merrill Lynch.
Wow.
Yeah, so she's got her money sorted.
Does he still have to work? Surely he can retire now on the proceeds of his daughter's very successful pop career.
Yeah, but well, it depends. I'm sure one is looking after her money, but two, us investment people, we love it. I don't want to retire. Not completely retire anyway. I might ease away and be an advisor, but I want to carry on. So look. So the serious point is one. The numbers are phenomenal, but then what I want to look at is kind of behind the scenes of the numbers. And there's legit, but almost certainly not reported in GDP. The Airbnbs, the small cafes, restaurants around, hotels. Okay, the big chains will get reported quickly in GDP, but something definitely not the black market. Do you want to try to check the black market in Taylor Swift tickets?
Go on. Well, first of all, what's the cover price of a Taylor Swift ticket? If I was able to buy one,
£180. Well, in London, it's about £180.
Okay, no, that's okay.
First question I have is well, firstly, she's doing 13 concerts in London.
Okay.
Yeah, and only 6 in Germany, and Germany's a much bigger economy, obviously.
Yeah.
What's going on there? You spent time in Germany.
Yeah, I did. I mean, there is a thriving sort of live music culture in Germany, but it seems to be a lot. It's like the thing you went to at the Royal Albert Hall. There's a lot of Rick Astley and that kind of thing. It seems to be very much kind of sort of 80s bands or Eros Ramazzotti, who, for those who don't know, is an Italian crooner, or kind of German heavy metal bands. But I'm surprised that it maybe indicates perhaps a sort of reluctance in the German community to spend huge amounts of money going to see the latest pop star.
Okay, exactly. So, and it shows the UK is such a service economy. I think so. Her first concert so she starts in Sweden again. So no doubt they'll blame that for. So I'm just looking at StubHub, and there's many for the first date in London. There's 500 tickets available. Okay. Right, the cheapest is 1,500 each.
Wow!
And if you want a decent seat, 4,200 each.
Crikey!
This I don't get. The most expensive, front standing, 6,200 each.
Well, it's still less than a Birkin bag.
You know what? I have got a 10-year-old daughter who is into Taylor Swift. No surprise. So I showed her these prices, and she said, "Get them for me, and I'll pay you back." Famous.
What interest are you charging your 10-year-old daughter?
Yeah, exactly. Well, we'll come back to now. For those who want to go and see Taylor Swift, in the black market this Sunday, tickets are available in the black market for £35 in Rio de Janeiro. So forget the ridiculous black market tickets in London. Get a flight to Rio.
Yeah.
Have a lovely time there and get to watch it for nothing. So that tells you something about South American economics right now.
Yeah. But I saw, sort of, before we sort of broaden this out a little bit, I did see that apparently for the opening night of the Eras tour, which was in the stadium that was also the venue for the Super Bowl about a month earlier, there was more business generated by that one night, that first night of her concert tour, than the Super Bowl. And I always think of the Super Bowl as the biggest sort of economic event in the US, as far as sort of, revenue and advertising and general sort of consumer sort of spending. And also I saw, what was the other thing I saw? I think it was Morgan Stanley have estimated that the combined contribution of Barbenheimer, which is the Barbie movie, Oppenheimer movie, Taylor Swift, and Beyonce, going back to our Beyonce blip, they reckon that will have added $8.5 billion to the US economy in Q3. That's incredible.
It is absolutely incredible. So completely agree. But I'm talking about the stuff that's formally included off the radar. So it comes back to revisions. This pessimism about the UK.
Yeah.
We've already had we're now post-pandemic in the middle of the pack. Revision worth about 2%. But I've gone back previous occasions, 2010 to 2012, upward revision in total of 2.5%. And 1990 to 1994, they had to up. The upward revision was as much as 4%. So even before this digital service economy, the UK has always been, look, we're no cheerleaders for the UK. We recognise it's tough times. But take UK GDP and any comments like the UK is struggling in recession, realize that the true numbers are much higher. And Taylor Swift is kind of a great example of that. And look at it, 13 concerts in the UK versus 7 in Germany, just a couple in Italy, and the UK is absolutely a powerhouse when it comes to the service sector in this kind of business. Yeah. And good luck to her. I'm not buying tickets to the black market, but if anyone has any, do feel to get it at face value. Do feel to get in touch. Feel free to get in touch.
Yeah, and because I just on the final note on that, I did see the research, and I can't remember who had done it now, that basically sort of Gen Z or Gen Z. And millennials prefer to spend money on life experiences rather than save. So I guess this is a story that's going to run, this sort of vibrancy in the economy as a result of sort of spending on experiences, spending on going to concerts, going out for dinner, holidays, flights, rather than big ticket items.
Exactly right. I think that's it. So look, a bit of fun with the Taylor Swiftonomics. We should have been on it earlier because people have been talking about it. I mean, Bloomberg have a whole section on it. Every month or so. So quite incredible. But I'm kind of interested. In as I say, what's not included in GDP, and maybe an indicator that the economy is stronger. And just finally, because I do remember 2008 in contrast, Glastonbury, normally a difficult ticket. Got them face value at HMV a month before, and that was a real economic crisis, obviously, and so forth. You were nowhere near that today.
Yeah.
So with that, I think Alex's wines are starting to slow me down.
Okay, well, I won't sort of challenge you anymore. Thank you very much, Alan. A reminder that the views expressed in this podcast are not intended to constitute investment advice or fashion advice, for that matter, are accurate at the time of recording and are subject to change. Thank you very much again, Alan, for joining me today. Don't forget to check out the podcast page on Coutts.com. And of course, you can subscribe and please review the podcast wherever you get your podcasts. Until the next Need to Know, bye for now.